Hi traders, welcome to the Ken Tank, where you'll learn how to avoid getting eaten by the sharks on Wall Street. It's always all information for educational use only. I'm not making advice about what to buy, sell, or hold. Hello active traders, this is Ken Calhoun, president of Trade Mastery and Day Trading University, coming at you with another episode here of the Ken Tank. We're going to look at great gaps versus goofy gaps, or goofball gaps. This is a great gap chart. The reason for this video is to alert you to the danger of what I've seen being a disturbing trend out there with some of these young kids claiming to be day traders that are telling people to trade under $5 stocks and just promptly blows up people's trading accounts. Potentially. What I want to teach you is the difference between stock charts that are worth trading for gaps and those that are not. Let's take a look at a few good gap chart examples here, or great gaps in this example. You have a minor gap of, say, and this ticker is CBI. It gapped from 2760 to 2880. It promptly ran Friday all the way up to 32. So it's a 3-point run on the open. You know, you could have done very well had you gotten in anywhere on the gap continuation. That type of chart is perfect for professional stock day trading. It has high volume of at least 15,000 shares per minute. That's really important. It's got a wide average true range or wide open range breakout run following the gap. And it could have made very good potential, up to 80 cents or $1 or as much as a couple dollars on the run, had you gotten in anywhere on the breakout. Here's another good one. It ran up a little faster, GIMO, but it ran all the way from 51 to 56, so a 5-point runner. These are the kind of charts that professional day traders we like to trade. Something that actually has legs, and once it does break out and run, it'll start off its day with a nice minor gap, and by minor I define that as being less than 10% of the price. So a $40 stock that gaps, less than 4 points up, which this one did, is fine for going in long on a breakout continuation. Here's another one, TER. It gapped up. This one kind of went up and down, but it did really nice on the open. It went all the way from 23 to 23.70, or 23.65. So just around 60 cents worth of price action. So those are the kind of great gap charts that I want to encourage you to follow if you are looking at gaps. This is the best gap chart I can find in the whole stock market from Friday, October 28th. As we approach Halloween, don't get, trick or treat. Don't get tricked by the bad people out there that are telling you guys to trade cheap charts just to blow up your trading account. Because, here's an example of a gap that would be horrible to trade. These are 3 really awful gap charts. These are goofy gaps. In contrast, LPG is a really horrible gap chart. How could you possibly make money unless you're scalping thousands of shares for 2 or 3 cents? That's a losing proposition. Or GSB, the thing ran all of 20 cents. You would have had to get in and out, and the thing had such low float, such light volume, you would have had huge, humongous spreads. It would have been virtually impossible to trade this gap chart with real money trades correctly, GSB. The odds would be really low. Here's another horrible chart, OCN. It ran all of 20 cents or 30 cents. You would have had to get in and out kind of like a video game. It's what I call pop and drop charts. It's another type of an evil gap chart or a horrible goofy gap chart. You would have had to trade, number one, a lot of size, like 500, 1,000, 2,000 shares, and you would have had to make your round trip decision within 2 minutes to make a profit on this thing. I don't know about you, but I think that's a low odds chart and would be really particularly stupid to trade. That kind of chart, on the other hand, is much better chart. So, great chart, goofy chart. Great gap, goofy gap. Great gap, beyond stupid goofy gap, right? So if you're looking at what kind of charts make sense to trade, it's really important, folks, that you understand there's a clear difference between things that are easily manipulated, like the penny and cheap stocks, and the nice wide, multi-point running gap charts that actually have a shot of working. You may have seen my articles in Stocks and Commodities magazine, or me speaking for Money Show or other industry channel partners, and I always say I like instruments in the $20 to $70 a share range, and my sweet spot is here in around $30 a share, 20, 30, 40 a share, maybe up to 50 or so, and you got really nice volatility and run and movement in these charts. Because as traders, the 2 V's that you need are volume and volatility. So this has both, right? Great volume, good volatility. And on your scanner, even if you got in late, somewhere north of 30, still ran up 2 points or almost 2 points after that. So you would have had 15, 20 minutes for it to show up on your alert scan. I use eSignal, and I like to use the leaderboard scan, and I'll pull up the percent gainers as one place to find gappers. The other is the unfilled gaps, where you can also look at very short-term up and down charts. But typically the main thing we all look at is percent gain and loss charts list to see which ones have large volume and large volatility, and then drill down from there. Kind of like an eye test, right? Which one's clearer, A or B? Which one could, when I look at a chart, I figure out which one could I potentially make the most money with, and how could it go sideways if I traded it incorrectly. This one is a great gap chart, so I don't have any particular reservations about this one. Again, either for a drop, for a short on a fail to break up to new highs, break out to new highs, or a gap continuation if it does continue to skyrocket on up, right? And those type of gaps are really important to look for on the open. Just beware of these cheap little $3, $4, $5, $6 junk charts that you would have had to play like a video game and trade thousands of shares, risking enormous capital, only for a tiny, the risk reward. The numbers are all wrong. Your odds are wrong, right? The numbers are wrong. And I call BS on anybody who's trying to tell people to trade cheap, crappy charts like this one. I mean, really? One of the trick that some of these kids are doing is they will zoom in on a black background chart so that they kind of conceal the low volatility. If you put your nose close enough to any chart, you can find a spot where it's going up and say, oh, it's going up great, look at that. But to a sophisticated professional trader, we call BS. You look at that and you say, look at the range. This thing went 580 to 610. It's only got 30 cents a range and zigzagged most of that. So how in the world could you possibly do well trading that kind of chart? This kind of chart, though, it's got a nice sustainable run. Kind of a quick, to close out the list here. And again, it's just, I've got so many traders that come to me after getting in trouble with other people, especially these newcomers, these kids that don't know what they're talking about. Beware low credibility people. They haven't been in the trading industry very long, or they're newcomers. They haven't published articles. They're not professional speaking, respected educators and the rest of it. Many of them have been claiming to trade live when they're not. They show demo accounts and they try and pass it off as live. Unfortunately, there's been some very positive movement from the regulatory compliance agencies to shut those kind of people down. They'll sit there and claim to be making thousands of dollars in consistent profits and a lot of BS when they're not. And that's against the law. So hopefully that'll continue and clean up, take out the trash out there in the industry. A lot of these bad people will make BS promises. If you see words like financial freedom or consistent profits, or they post percentage gains, run, don't walk away. That's really bad in the industry, right? If they show lifestyle videos, it's just amazing that people fall for this. Because for those of you who've been around for a while, you remember back in the 90s, back when day trading first started, us original .com day traders, you'll remember there were these brokerage commercials where they'd show, Joe the truck driver now owns an island in the Bahamas because he's day trading his way to financial freedom. And, those of us who are sophisticated know to call BS on this. But a lot of the younger people, I'm afraid, it seems like a lot of the millennials, or the young guys and then ladies in their 20s and 30s are getting sucked into the BS out there with lifestyle videos that some of these con men out there are saying that they're making fortunes trading, and they're showing sports cars and fancy houses and tropical beaches and all that kind of crap. And unfortunately, the hype is selling, apparently, because they're still around. A lot of times you see a lot of young guys with no industry credibility claiming to trade these cheap charts, making thousands of dollars a week, but there's no transparency, selling hype, there's no tax returns to prove it. Heck, many of them were just in high school 15 years ago. Why would you trust somebody who's flipping burgers? I got shoes older than some of these kids out there claiming to be professional traders, so be cautious. Like I said, they'll often use black background charts to mask how low volatile, and it's a trick, right? It's a lot of smoke and mirrors out there in the trading education industry, and you really have to be an educated consumer and, be cautious and skeptical, rightfully so, of just because there's a lot of social proof and they get a lot of YouTube videos or they got a lot of people in a chat room doesn't mean it's honest. It doesn't mean that it's the truth of the situation. So I would just, as one trader to another, one friend or colleague or whatnot, I would say be careful of those tricks. What I meant by that, like I said, is they'll pull up a cheap chart and then zoom in on it with a 1-minute candlestick chart and say, wow, it's running, and make it look like it's got a lot of trade potential when in fact it doesn't. So beware of that. Just a couple of personal notes so you know why. I avoid the sub $5 stocks because they have low float, wide spreads, they often get halted, they have low open range breakout volatility, meaning they don't run 50 cents or a dollar. These kind of charts are great for day trading, right? It's so much smarter to trade 100 shares of a $30 stock with a nice multi-point range than 1,000 shares for the same capital outlay, the same $3,000 worth of your capital account being used, and 1,000 shares of some junky $3 stock with a 20-cent trading range. And that should, on low volume, no less. That should kind of make common sense. But unfortunately, there's a lot of flim-flam out there in the industry. So, these are the type of charts you want to focus on. With the cheap charts, the problem is you'd have to scalp with risky over 1,000 share size. It's very dangerous, what I call pop and drop charts. They run up 20, 30 cents and they promptly give it all back a minute or two later, leaving people losing money. And so from a cautionary standpoint, I would encourage you to learn the right way to trade good professional type charts like this for great gaps, not these goofball gap charts that run up 10 or 20 cents and then immediately take everyone's money back and leave bag holders at the top saying, well, you said to go long 1,000 shares and now I'm down $600 in my account. What happened? And then they'll blame you for missing something, and that's not correct. You need to trade the right instruments in the first place. So, I call BS. Anybody out there in the industry who's claiming to profitably trade sub $5 stocks, show me your tax return with the ratio of the P&L of how much you made trading that versus how much you made trying to sell the dream to traders. And I am completely confident you will not see anybody out there with larger P&Ls from actually trading those type of instruments compared to what they're trying to sell traders with services and courses and whatnot. So be cautious. The other thing to be careful about, E-minis are better than those charts, by the way, from a day trading standpoint because the liquidity is there and you got more volume. So at least you've got that, and you don't have big spreads or halts or that kind of thing. So, if you're going to trade something that's leveraged, personally, I believe that the potential may be a little better for futures contract trading, but I still don't like them because overall they're choppy, they're high risk, they got narrow ranges. If you look at the E-mini chart on any given day, it's very choppy. The only exception, and this is true for spiders or Qs or diamonds or any index tied ETF, it's best only on rally 2-day high breakout days or big sell-off 2-day low breakdown lows. But the other 90% plus of the days of the market week or the market month, it's better to just focus instead, in my opinion, on good strong gap charts that are what I call great gap charts like this, right? It's my single favorite chart pattern. Any good professional trader, they'll tell you gaps. The trick is you got to trade, or the limit is you got to trade good gapping charts that actually have nice wide trading ranges and have high volume and high volatility, right? Charts like this are perfect for stock day trading, right? I'm the industry's go-to guy for professional stock day trades. I've been teaching traders since the 90s. These are the type of charts you really want to focus on. These type of charts will just burn up your trading account, right? Why on earth would you trade anything like this? Put it in kind of, next time you're thinking about trading a cheap chart, if you ever make that mistake, pull up a 2-day complete 1-minute candlestick chart and just take a look at how horrible the chart is. Never mind if some wannabe educator kid is saying, look at how big the range is. Look, visually it's 5 cents. Yeah, well, big whoop. But they try to make it out to be more than it is. It's not. What you want to do is trade something that's got points, not pennies. That's my last thought. Points, not pennies. Good alliterative copy there. Trade things that have gap continuations that'll run at least a point and a half or so in a single run. not these penny charts that only run 10 or 20 cents, and you got to time it so carefully, your odds are much, much diminished. That's my professional assessment. The cheap charts that are low volume and have wide spreads and often get halted and have all kinds of problems and are easily manipulated by people running so-called educational services are really dangerous to trade. I like things that have high volume and high volatility like these charts. So Ken Calhoun with another quick tip on great gap charts versus goofy gaps. Great gaps, goofy gap. Great gap, goofy gap. Got it? It'll catch. And so spread the word on social media. Tell a friend. Feel free to post anywhere in the world. I said that it's best to, at least I personally, I like to focus on charts, at least in my own trades, that have better ranges, superior volume and volatility, and the odds are much better of actually making a trade work out when you land a chart like this, of which with so many gaps lately this last month or two in the markets. Focusing on the strongest high volume, high velocity gappers like this is so much smarter than trading those risky $3 and $4 stocks that pop and drop, the one-hit wonders. They go up 10, 20 cents and then immediately fade right back down, leaving you with a big stop loss and a hole in your account wondering what happened. Well, it's because you're trading the wrong instrument, being misled by people who don't actually know how to trade. So I would encourage you, in my estimation, instead to focus on great gap charts like these. In my estimation, it's much more intelligent to trade 100 shares of a $30 stock that actually has volume and volatility and great trade potential than 1,000 shares of a $3 stock, though both trades cost the same amount of capital, 3,000 of capital to make the trade. Much smarter to trade 100 shares of something that runs like this than 1,000 shares of something that doesn't run like that, right? So make sure you have the right charts. Until next time, this is Ken Calhoun wishing you the best for successful active trades. I'll see you in my live Trading Open room and my Swing Scan Swing Trader training. So be sure to join either Swing Scans or Trading Open, or so many of you have joined both. That's fine too. I'll see you inside the members area in our upcoming training. And until then, best wishes for success in professional, great gap trading, continuation plays, and nice strong instruments that actually work. It makes a difference. Take care and goodbye. Be sure to join my subscribers at swingscans.com and tradingopen.com so you can see these types of alerts in each week's markets.